welcome to the monthly outlook on markets. Indian equities have been struggling in this year, 2025, with a sharp fall in indices, particularly in the mid and small cap segments. This decline in markets has significantly reduced the divergence in performance of different indices. In fact, the return profile across the indices is now quite similar. At one point during the year, the overall returns of these indices were highly divergent. Nifty returns from April to September were about 18%, while mid and small cap indices delivered about 26 and 33% respectively during the same period. Following this fall, performance across market caps for this fiscal is now almost identical. After the volatility in markets over the last few months, we believe that certain factors have shifted from an economic policy perspective and is now warranting stability in markets. Obviously, over the long term, it's the earnings of businesses and their capital efficiency that drive performance of markets. Since COVID-19, the stance of monetary and fiscal policy has been tight. There was huge control over liquidity and fiscal deficit. However, we are now seeing a gradual shift, predominantly from the RBI. The RBI's decisive and proactive approach towards managing banking system liquidity. The RBI has purchased Indian government bonds worth Rs 2.6 lakh crores, including the planned 50,000 crore auction on 25th March, with 2.3 lakh crores acquired in the past 45 days alone. Additionally, the USD INR swaps totaling approximately 1.3 lakh crores have also been executed, with another $10 billion already scheduled. We expect the RBI's Monetary Policy Committee to continue maintaining its accommodative stance and prioritize liquidity in the system. This could lead to a decent about 75 basis point rate cut in the coming fiscal, with a further potential additional 25 bips cut in the year thereafter. This is assuming headline inflation moderates and inflationary pressures remain subdued. Such policy measures should support lending, albeit with a lag, and drive economic growth and corporate earnings. Although system liquidity remains in deficit, averaging about 1.4 lakh crores in March 2025, compared to Rs 2 lakh crores in January 2025, the liquidity situation is expected to shift into a moderate surplus by Q1 of FY26 as seasonal pressures ease. The RBI's proactive liquidity management has helped stabilize market conditions and strengthen fiscal resilience amid global uncertainties. On the global front, a softer US dollar and declining crude oil prices provide a supportive backdrop despite ongoing trade and geopolitical uncertainties. Furthermore, as liquidity eases, yield moderates at the shorter end of the yield curve, we believe risk-on behavior can increase. If the RBI accelerates liquidity injection in fiscal year 26, markets are likely to price in further rate cuts amid softer economic conditions. This, in our assessment, should boost investor sentiments towards Indian equities. Additionally, due to a reversal of foreign portfolio investor flows, due to a rather fair valuations, could lead to a superior risk-adjusted returns going forward. This was about liquidity so far. Let us now move on to earnings outlook. At the end of the day, earnings are the hallmark of any markets. In the long term, it's only earnings that matters the most. Eventually, it's the earnings and capital efficiency that creates long-term value. FY25 has been a year of subpar growth in profits for the economy. India in corporate should close this year with mid-single-digit profit growth. However, we expect this growth to pick up in FY26 on the back of low base of FY25, improvement in economic activity, normal monsoon, and also possibility of some semblance in the world order. It is expected that Nifty profits should rise in mid-teens in FY26. Coming year should see support from acceleration in revenues and also aided by some margin improvement for India Incorporate. This pickup in growth could be a supportive factor for equity markets in the volatile environment. Sectors that may lead growth in earnings include mix of cyclical and structural businesses like cement, telecom, consumer durables, industrials, commodities. If prices remain elevated, this should be another year of low growth for Indian IT software services companies. Although growth may be slight improvement from the current lows seen in fiscal year 25. This ongoing correction in markets have resulted in valuation adjustments, creating pockets of opportunities. At ASK, we believe markets are back to 101 of investing. Focus should be on growth and the quality of that growth. Most of our portfolios are expected to report high single digit to low double digit higher profit growth compared to the benchmark, along with capital efficiency or ROCs that are significantly superior. We have relatively higher investments in sectors which should show relatively higher profit growth, including telecom, consumer discretionary, manufacturing, and healthcare, which according to us should be growth leaders. In a relatively slower growth economy, we believe businesses that are growth leaders should start to command valuation polarization in the marketplace. Thank you. Happy investing.